One. And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Brian Goodstadt, who's a managing partner and CIO at Paragon Capital Management with about $1.1 billion in assets under management. Brian, thank you so much for taking the time and welcome to the Smart Money Circle.
Pleasure to be with you today.
So, Brian, I always like to begin. Can you please tell us your story and how you got to where you are today?
Sure. My journey has taken me through investment research, investment management, hedge funds, and now investment advisory and wealth management, where I am today. And it began about 30 years ago, hard to believe, but I got my MBA at Columbia Business School, and then I pursued the CFA program. And I went through the CFA program while working for S&P, Standard and Poor's, doing equity research on technology companies in the late 1990s. So that was a fun time to be covering tech stocks. And then I worked for a couple of investment firms, including a hedge fund as a co-portfolio manager. And then after a decade or so of investment research, investment management, I moved from New York to Colorado in 2002. And I worked for a small hedge fund here in Denver as a portfolio manager. And then eventually I joined Paragon in 2005. And I originally joined Paragon to start a hedge fund for their clients. And for various reasons, we shut down the fund after 2 years. And at that point, I was asked to stay with Paragon and become an advisor and wealth manager and start working with clients. And so I jumped at that chance since what I found was the hedge fund world was just so short-term performance oriented, which wasn't really for me. I wanted to focus more on building a long-term business and long-term career. And I wanted to work with clients and develop relationships. And I also just wanted to do things beyond the investment world. And we do things like tax planning, retirement planning, estate planning, and a lot of other things. And so I've been doing that for the past 18 years. And then finally, over the last 5 years or so, our two founders at Paragon retired. And so a few of my colleagues and I have been buying into the firm. We're the next generation succession plan. And so now I still work with my clients as I always have, but now I'm also the managing partner and chief investment officer at Paragon. So that's the 30,000 foot, 30-year view of how I got to where I am today.
I love that. So, congratulations on the success, and I love the story. So, let's talk about your business and your investment strategy, please.
Sure. Um, so first of all, as I said, the business is partly investment advisory for our clients. So we manage about 1.2 billion dollars in assets for about 180 clients. But we also do all sorts of other financial planning and wealth management services. On the investment side, our strategy is basically to build a globally diversified portfolio of high quality stocks and bonds with an emphasis on less speculative assets. Um, the way we look at it at times is our clients usually come to us with a lot of money. And so we're not here to make them rich. We're here to invest prudently and not lose all their money and make a decent return. So we tend to focus on high quality stocks and bonds. We have some alternatives as well. We tend to outsource much of the investment management to fund managers, mostly mutual funds. We do have some passive ETFs, but it's mostly active mutual funds. We occasionally invest in some hedge funds and alternatives. And we tend to focus on pretty long-term cycles. And so just for example, over the last 15 years or so, international stocks have really lagged US stocks by a historic margin. And so we think in the next cycle, international is going to do very well. It's been tough to time that, but we have about 35% of our stock portfolio in international stocks. And similarly, small cap stocks have been really out of favor for a long time now. And at some point, we think that's going to turn. Again, it's been tough to time, but we have about 15% of our stocks in small caps. So, part of why we focus on quality, as I said, we're trying to uh, not lose our clients' money, but part of it is, nearly 60% of all stocks every year actually underperform cash, which is pretty amazing. So by avoiding those really bad companies that could really torpedo the stock performance, that really helps in building long-term wealth. So that's part of why we focus on quality. We also tilt a little bit towards value stocks. And again, this goes with our long-term focus. In the short term, valuation really has very little impact on the stock market. I think the correlation between valuation and 1 year performance of stocks is basically zero. But if you look at over a decade or so, valuation is very important and really drives a lot of the performance. So, so when you put this together with really high quality stocks and bonds, and focusing on value as well. The way our portfolio tends to perform is if there's a raging bull market, we tend to lag the market, and we're okay with that, but we tend to do well in downturns, as we're having here in March 2025. This is what our portfolio is designed for. I think year to date, here we are on the last day of March, and most of our clients are actually up slightly because the bonds and the international stocks have helped uh, cushion the blow that the U.S. stock market has taken. So that's generally the way we tend to do things here.
I love it. So you're basically looking for not so much asset allocation in a untraditional way, trying to word this properly. You're looking for pockets of strength that most people overlook. So instead of chasing performance, you're allocating your portfolios to benefit from the norm, if you will, instead of chasing the next shiny object or whatever that hot idea is du jour. Is that a good way of summarizing it?
Yeah, absolutely. We're trying to ignore the short-term noise because there's a lot
Yeah.
of noise
Yeah.
and focus on long-term trends, long-term cycles, invest with really strong active managers who have proven their worth over many years and many cycles. And so that's really what we're looking for. And as I said, part of what we try to do is smooth out the returns. And one reason for that is, just the way the math works. If you're in highly risky stocks and you suddenly find yourself down 50%, then the way the math works, you have to make 100% just to get back to where you started. Whereas if you could smooth out the returns, maybe you're down 10%, you only need to make 11% to get back to where you started. So it's a lot easier. So we try to smooth things out, ignore the short-term noise, and focus on the long term.
Love it. Okay, let's talk about risk management. It's a good segue. Please tell us how you handle risk and some mistakes you see people make with respect to risk management.
Sure. Yeah, risk is probably the most important thing in our portfolio. And I think the way we do it is just the way we structure the portfolio. And as I mentioned already, we're focused on quality. We try not to stretch for yield, which is what I see a lot of people make mistakes with. So on the bond side, we're in a pretty high quality bonds. Occasionally we'll go into high yield when spreads warrant it. But I know a lot of investors just look for what's the highest yield I can get. Well, highest yield is good for a while, but highest yield tends to mean highest risk. And so at some point, that's going to come home to roost. And so we try to avoid trying to stretch for yield. As you mentioned before, it's like the shiny object. We're trying to avoid that and just stick with quality. And now most of our clients will have 30, 40, 50% in bonds. And so that's part of the risk management strategy to smooth out the returns. Most of the time, 2022 was an exception, but most of the time when the stock market is really struggling and declining, bonds will rally and help cushion the blow. So that really helps. Um, We also have some alternatives in the portfolio, which tend to do their own thing. They don't, they're not necessarily correlated with the stock market, so often they could offset any decline in the market. So those are really some of the main ways we tend to manage risk. The other thing I see, a lot of people wanting to do is, you know, they often want to just sell at the bottom, obviously, when things aren't going well, and they think that's a risk management strategy. But we try to not react to the market and be more proactive. And so just the way we structure the portfolio really helps manage the risk.
Love it. And then let's talk about shift the conversation a little bit to some timeless lessons. What are some timeless lessons you've learned along the way that you'd like to share with the audience?
Sure, there's probably a number of things over 30 years. One thing is the stock market is not the economy. And, it's something that comes up a lot. Really after the financial crisis for the next decade, the economy wasn't doing very well. It wasn't growing fast, but the market did phenomenally well. And similarly, sometimes, the economy is in recession, but the market is forward looking and thinking about, well, we're going to get out of this recession soon, and the market starts roaring. And so I think it's important to distinguish the stock market and the economy. They are two separate entities. They don't necessarily move together. And a similar lesson is that there's a difference between a company and a stock. And I often hear, hey, I want to buy this stock because it's a great company. Well, the most other investors probably already know it's a great company and it might be priced into the stock. And so the stock is different than the company. So that's always something I see come up a lot over the years, and those are some good lessons. And then, of course, the old lesson is always stay invested and don't time the market. And, it's always tough to do to stay invested. But if you look over the last century, uh, we've had wars, pandemics, global crises, recessions, you name it. And over the last 100 years, the U.S. market is up 20,000 fold, which is hard to comprehend, but it's about 10% a year, but it's 20,000 fold over 100 years. And so, and again, sometimes the market just goes up in the face of these bad events. So it's tough to just try to time things and just try to stay invested, stay focused on the long term. Again, going back to the short term versus long term, in the short term, the probability of having a negative return in any one quarter is about a third, 35% chance that the market can be down in a quarter. But if you're looking over a decade or so and you stay invested, your chances of having a down decade are maybe like 5%. So the longer your focus, the better your outcome tends to be.
Gotcha. So, by the way, you just shared something really, really powerful right there. It's almost like time arbitrage where you're not looking in the short term. Most people are looking at what's in it right now, and you have those blinders on of like the next shiny object, but the next 30 seconds or 3 months or 3 days, but you're zooming out and you're looking at the whole forest, not just the trees or the leaves in the trees, which would be every tick or every day. Is that a correct way of summarizing what you're saying?
Yeah, absolutely. So if you figure going back historically, the US market has been up 10% per year on average. And I could talk about why I think that might be overly optimistic going forward. But if you were to make 10% per year, your money will double roughly every 7 years. That's pretty powerful. So especially if you get started investing at an early age, you could have a lot of periods of doubling. So staying invested and focusing on that long-term power of compounding, which is really impressive, in the long run. So that really helps.
Love it. So, next question. How about timeless mistakes?
Yeah, timeless mistakes. Um, well, sometimes it's the opposite of some of the lessons I've shared, but yeah, some of the things that I hear from a lot of clients is, you got to call and say, hey, I read about this stock in the Wall Street Journal. Sounds like things are going great. Therefore, we should buy the stock. And usually by the time an article is written about a company that things have been going great, usually the stock is already up a lot. And so then you're already kind of reacting to, after the fact, to once the news is already out. So that's usually not a great strategy. So you want to get in early, obviously. Another mistake I see a lot is, going back to my tech stock analyst days in the 90s, is um, you can't lose with this stock, with this investment. It's safe. It's just going to keep going up because that's what it's been doing. And everybody else is owning it. So therefore, I want to own it. Well, if everybody else already owns it, it's usually not a good sign. Usually the next step is for people to start selling. So try to avoid the herd, I guess is the way to say it, and not just buy what everybody else is owning at the time. So that really helps. And it's that was the dot coms in the 90s where everyone just had to own the same shiny objects, or even Enron in the early 2000s. There's always these hot stocks that everybody just has to own, and doesn't always end well.
Yeah, no, makes perfect sense. Okay, let's talk about leadership. You've been around many different places. You worked East Coast, you worked in Denver. You've been in hedge funds and money management firms for decades. What makes a great leader, and what are some lessons you've learned about leadership that you'd like to share with the audience?
Sure. First is, at least to me, ethics is the most important thing in this industry. There's a lot of uh, laziness in the financial industry that you see in the papers, and I think staying above that is the most paramount thing. And so I spent 6 years working, volunteering with the CFA Institute's Disciplinary Review Committee, where we looked at CFA charter holders who might have been accused of some wrongdoing, and we could revoke or suspend their charters. And I volunteered because I think that is really important to me. So don't ever compromise on ethics. And then when it comes to working with clients like we do here, I think the most important lesson is always do the right thing for the clients, even if it's not in our financial best interest. There's a lot of scenarios where, I might have a client come to me and say, "Hey, I have this other account in another firm. Can you take a look at this account and tell me, is it okay? Should I be selling all these? Should I transfer it all to you guys to manage?" Obviously, in my best interest to say, "Hey, yeah, transfer it all over to us." But we really try to be objective and give an honest opinion. And I think clients really, see that and appreciate that. So always do what's best for the client, even if it's not best for us in the short term, and it'll tend to work out best in the long run. And then in terms of dealing with clients, or really any meeting, what I find that is the key to a meeting is being a good listener. Many of us, we have, I have a CFA, MBA, and we have a lot of knowledge. We want to share everything we know and everything we've learned. And I've been in some meetings with our other advisors where they spend the entire meeting with a client talking and just sharing all their knowledge. But I find if you reverse it and ask them questions, let them talk, they usually come away thinking, "Wow, that was a great meeting." And so try to focus on listening skills. That's a really important lesson that I've come away with.
I love that. So that's what I try to do here on the show, where I learn to be quiet and let everyone else talk.
Yeah,
And
that's definitely a podcast interviewer skill. I listen to a lot of podcasts, and some of them, yeah, like you, let the guests talk, and some of them are just constantly interrupting.
well, thank you kindly. I appreciate the kind words. All right, Brian, final question for you. What is the best piece of advice you'd like to give the audience or your 30-year-old self?
Yeah, for my 30-year-old self, it would be really start investing early, and um, early and often, as they say. As I said, if you could double your money every 7 years, 10 years, whatever it is, you could have a lot of doubling periods. So I think that's really key to just get invested as soon as you can, and try to ignore the short-term noise. There's so much noise, whether it's on TV, in the news, on tweets coming out of the White House, whatever it is. Every day there's some news story, up, down, and it's really hard. But you have to try to tune that out. And most of the pundits you see on TV, they're usually wrong. So don't just take their word for it. Just keep investing, and in the long run, everything will work out okay.
Love it. Well, Brian, thank you so much for taking the time to speak with me today. This was absolutely fantastic, and hopefully we'll have you on again soon. Congrats with the success.
Great. Thanks, Adam.